Breaking news as Intel announces the biggest mass layoffs in Oregon state history, according to sources, as the state's #1 corporate employer continues to show signs of financial distress. Now, in addition to that breaking news, Walgreens has also given us their own breaking news as they've announced the closure of over 1,000 stores across the nation, which is going to lead to additional mass layoffs. So we're going to go over that in today's video flow. That's going to go like this. Segment number 1 is going to be what's new in the labor market. I'm going to go over that report from Intel, the report of mass layoffs from CVS, and a third story that I did not want to touch, but no one's reporting on this, which is the Democratic mass layoffs that are going on right now. What does that mean? I don't know. We'll try to figure that out. Now, segment number 2 is going to be, what do you think, Mitch? Well, Mitch gives his insights and perspective based on the report that I give to you guys. Segment number 3 is going to be in other news, and I'm going to take you guys into the Walgreens store closures, as well as giving you guys a report on the world's #1 retailer of 84,000 stores that has also announced that they are closing stores in the US. Now, after that segment, we're going to go into segment number 4, which is what would you do, Mitch? Segment number 5 is going to be one of the most important segments that you guys have ever watched, which is going to be Math Matters. And Mitch is actually going to give us a breakdown of what the risks are of bonds. Essentially, you guys, right now, what's happening is corporate and state bonds are robbing America of their ability to retire. Mitch Wexler, happy Wednesday, sir. I'm looking forward to going into this video. How are you?
Okay, this should be very interesting. It's going to be a lot of information fairly quickly. We're going to try and hold the time frame down for everybody, and we'll see how this goes.
Easier said than done, but let's start right now. 1,300 Oregon Intel employees set to be laid off. Intel plans to lay off approximately 1,300 employees in Oregon starting on November 15th, according to a notice the tech giant sent to state officials. The planned layoffs will occur at 4 of Intel's locations in Oregon. The tech giant is Oregon's second largest private employer, but their #1 corporate employer. It announced in August that it will cut 15% of its total workforce, which is close to 15,000 jobs worldwide. This is part of the broad-based cost savings plan we announced in August. We are making the hard but necessary decision to reduce the size of our CEO bonuses. I'm just kidding, you guys. It doesn't, Mitch, it does not say CEO bonuses. Obviously, it says workforce. My point is dang these CEO bonuses. Now, these are the most difficult decisions we ever make. I disagree. I think the most difficult decision, Mitch, would be cutting the CEO bonuses. We are treating people with care and respect, and by people they mean CEOs. According to Intel's notice, the first wave of layoffs will occur during a 14-day period, unfortunately, starting November 15th. Employees laid off will be given either a 4-week or a 60-day notice. The tech company has struggled to keep up with competitors, particularly when it comes to incorporating, are you ready for this, Mitch? Their excuse is artificial intelligence. Now, at the same time, it's been making big investments in expansions in Ohio, Arizona, and Oregon, and that may be the bigger issue. In many ways, Intel has been seen as a bright light in Oregon's economy, helping the state to earn Silicon Forest nickname. In March, the company announced a $36 billion expansion of its Hillsboro chipmaking campus. Wow. The company has also been a major beneficiary, and here's the thing I want you guys to think about, of your tax money called CHIPS and Science Act funding from the Biden administration, pulling in $8.5 billion in taxpayers' money, including the people that they just laid off. I briefly want to pull up this article as well because almost no one covered this. I couldn't believe it, but CVS is set to lay off 2,900 employees amid reports of another strategic review. Few bullet points here, guys. CVS plans to lay off 2,900 workers amid swirling reports that the healthcare behemoth is undergoing a strategic review, including a potential, this is interesting, breakup of its business. Number 2, the layoffs, which were confirmed by CVS spokesman, will affect about 1% of CVS's 300,000 employees. If they go bankrupt, that is going to be devastating to America and the economy. CVS unveiled a plan to cut $2 billion in costs this summer in a bid to bolster flagging operational performance amid rising costs for its health insurance arm, Aetna, and a shaky reimbursement at its pharmacies. One little insert right here because I wanted to know where their priorities lie. CVS Health Management Team and Board of Directors are continually exploring ways to create, here it is, Mitch, shareholder value. I say we just shut down Wall Street. Just shut them down and put that money towards cancer research or helping people affected by hurricanes or affordable housing, anything but making the suits even richer. We remain focused on driving performance and delivering high-quality healthcare products and serving enabled by our unmatched scale and integrated model. Unmatched scale, what does that mean? Unmatched scale of layoffs? I'm only going to briefly cover this because nobody else did. Take a look at line 97, 98, and 99 of the WARN Notice Mass Reporting Layoff System. You'll see that Democratic Committee, 318, 107. These are set to commence November 15th, November 17th, and November 15th. So I don't know what that means, but I think it's interesting to note that the Democrats and the committee are doing mass layoffs, and I could not find anything about Republicans. What does that mean? I'm not 100% sure, but I hope Mitch Wexler comments on that in our next segment, which is your turn, Mitch. What do you think about all this, sir?
There's quite a bit going on here, but the nexus between all these issues, such as CVS, be it Walgreens, Intel, be it your local school taxing authority, so your tax district, is bonds. And we're going to get into the bonds shortly, but that is the nexus between all this. And we're going to explain where the problem is with those bonds. And I'll just simply state that you have pensions, you have 401ks, the corporate bonds, people invest in US treasuries, and they're all held by mom and pop. And as we've said in these videos, and we've proven, and we've given you all the evidence, that mortgage exposure to mom and pop is clear when 37% of the population can't afford the roof over their head, and 67% of the population can't afford what the government is telling you is a median priced home in your local taxing jurisdiction. The nexus between all of this is the lack of risk mitigation and the bond exposure, because nobody wants to pay attention to what we're about to show you.
Let me ask you one question, though, because we have a little bit more time here. Is anything going on under the hood that maybe that math would suggest as far as like the Democratic convention? I mean, is that an indication who might win the election or not at all? What are your thoughts there? Because some people may think that's a sign of the Democratic committee quitting and accepting defeat. I didn't say that, keep in mind. I'm just noting mass layoffs with the Democrats, not the Republicans. Does that mean anything at all?
There's problems even in that statement, in that obviously Harris is a vacuous individual. She's not serious. She doesn't understand math. Trying to give money away that doesn't exist is what creates inflation. And inflation, since this administration took over, has been off the charts. So with that said, the idea that they're laying people off is a big sign that they're in trouble, but they should be in trouble. This is a huge problem. And we're going to show you even further what nobody wants to show you, what nobody wants to discuss, and it does show up in these bonds. So yeah, the reality is they're laying people off, but it gets even deeper because they're still having commercials out there. And those commercials say, give us money, send us $5, send us $15. Well, if you're laying people off, then that begs the next question. What are you doing with the money that you're getting from the people in the current advertising?
And I also want to make clear to everyone that's watching this is we are not saying to vote for anyone particular, okay? The ability that we have to talk about these things should be clear. Why are we able to talk about Republicans and Democrats? Because of the math. The math allows us the ability to talk about these things and hopefully not to be labeled this or that. Remember, you guys, the math, we don't have to take sides. We just have to look at the math. And when he mentioned the current administration, he's saying that because the math has gone parabolic. But also know, we're not so foolish to know that, hey, the debt's been going with every single presidency. So understand exactly what we're saying. The math matters. You matter. But let's move on now to In other news, Walgreens will close 1,200 stores across the U.S. This is as of yesterday, you guys, October 15th. Walgreens plans to close about 1,200 locations over the next 3 years as the drugstore chain seeks to turn around its struggling U.S. business. The company said Tuesday that about 500 store closures will come in the current fiscal year and should immediately support adjusted what? Earnings, shareholders, stock market, and free cash flow. Walgreens operates about 8,500 stores, so they have a whole bunch of stores left in the United States. If they go bankrupt, that is a huge problem again for the US. They have a few thousand as well overseas. All of the stores that they're announcing closure, the 1,200s, will be in the United States. Walgreens Boots Alliance leaders said in late June that they were finalizing a turnaround plan for the US business, and that push could result in the closing of hundreds of underperforming stores. I think they meant thousands, Mitch. The plan announced Tuesday includes closing of 300 stores that have been approved under a previous cost-cutting plan. The CEO said, "This turnaround will take time, but we are confident it will yield significant financial and consumer benefits over the long term." Are they saying that to their employees? Oh, that's right. They're not, because they don't care. They're saying it to the shareholders. Walgreens said in August that it was reviewing its U.S. healthcare business. More issues in healthcare despite the shortage of nurses. Go figure. Wonder if there's something wrong under the hood, Mitch. It might sell all of the part of its Village MD clinic business. Really surprised to see that. The announcement came less than 2 years after the company said it would spend billions to expand that business. So now they're cutting it. The company started 2024 by cutting the dividend it pays to shareholders to get more cash to grow its business. The drugstore chain then slashed its forecast for fiscal 2024. Let's not forget the #1 retailer in the world, which is 7-Eleven, is also shutting 444 stores in America as a plan to strategically generate $520 million through sale leasebacks. Parent company 7&I Holdings revealed in its quarterly earnings presentation on Thursday. The world's largest C-store retailer also agreed last month to offload an undisclosed number of properties in, you guessed it, North America via sales leaseback to profit of $520 million. Both moves coincide with 7&I announcing Thursday that it slashed its net income forecast. You guys see a pattern here for its fiscal year of 2024. And just real quick, I wanted to let you guys know that this report just came out as well, stating that almost 10 million pounds of meat are being recalled at Walmart, Trader Joe's, and other stores around the nation. And I'm sure that's just going to help with inflation and layoffs. But let's go into segment 4. Mitch, okay, what would you do, whether you're a small business or whether you're an employee, you see these stores closing down, coming right at you? What do you do, sir?
Before we get into that, let's talk about 7-Eleven's stupid idea of sale leasebacks. The entire executive suite at 7-Eleven should be shown the door. Sale leasebacks on that magnitude do not work. And the reason they don't work is because on a sale leaseback, you have a step up in annual payments to try to keep up with inflation. It's called a CPI index, but they goose it with regard to real estate. So in 10 years, the required payment at that time would be 25, 30% greater than it is now. Well, ask yourself this question. If the stores can't generate the money necessary now to carry the real estate, even on top of the real estate taxes, then how are they going to do that in 10 years from now? The idiots at the C-suite do not understand that you're giving up a short-term problem for a much greater long-term problem. In other words, it won't work. Their theory is it's going to be called asset light. Asset light doesn't work. So all it does is it turns 7-Eleven into a management company rather than an owner of real estate. If the shareholders of 7-Eleven had any clue what was going on here, I would strongly suggest that they get together and throw the entire board out the door. First thing. Second thing is, with regard to what mom and pop can do about this, these problems are massive, because when you get Walgreens closing down and you get 7-Eleven closing down and you get CVS, whatever amounts that they're closing down and whatever jurisdictions are closing down, you end up with areas that are no longer serviced. But it's deeper, because even Walmart is actually trying to back out of the healthcare provision. So what's happened, they're cannibalizing each other. If you're in the healthcare providing business, you're competing with each other. They put too many of them on every corner, and now it's blown up in their face. It is a massive problem because you have to have these communities serviced. And then they're going to say, well, but we'll be able to sell the drugs online and we'll do RoboDoc and all this other stuff. The key word is stability. And what you're looking at right now is no stability. And that is a problem. So coming back to mom and pop, we're going to get into how bad this starts to look with the bonds. And I'm going to do the best I can to tie this bond picture back to the real estate taxes.
Do you think it's possible that, given the challenges and issues, that Walgreens actually files for bankruptcy?
I would certainly hope not. Is it possible? Yeah. It's not good for anybody. They're going to have to downscale and do whatever they're going to have to do to stay afloat. There simply is too many of them. But the problem is they don't talk to each other, right? So if CVS is in one jurisdiction and Walgreens is another jurisdiction and Walmart is another jurisdiction, yet all three of them in the same jurisdiction say, we're going to close the doors. Well, you just built a desert that can't be serviced. And that's the problem.
Mitch, before I let you go under the hood on them, can I get your opinion on your thoughts on Intel getting billions of dollars from taxpayers, turning around failing, that leading to layoffs? Should they refund the taxpayers? I know they can't, but what are your thoughts on that, man?
It's, as I like to say, it's so much worse. You have these data centers. These are million and a half square foot data centers being built that suck up massive megawatts of power that the grids today can't handle. So the administration pumped money into these entities, i.e. Intel. They go and they start these massive data centers that suck up megawatts of power that are directly inverse to what the administration says, well, we're so concerned about pollution. You can't have these things in the same planet. So is that another problem? Yeah. Is Intel going to pay it back? No.
Of course not. No, I was kind of just, it was a rhetorical question that I was throwing on you to vent my frustration, Mitch.
Yeah, I got it.
So let's go under the hood now, segment 5, and I'll throw this form up, Mitch, and if you want, go ahead and talk about this form. Mitch is going to show you guys, and try to help answer the question, what if bond default happens? What are the risks? No one's talking about the risks in bonds. Your form is up here, Mitch, whenever you're ready, brother.
Okay, so all of these entities, coincidentally, that we spoke about this morning, plus your local school district is an entity and they put out bonds. So they're all connected with regard to bonds. And all I'm showing here in this spreadsheet is a very simplistic approach to trying to figure out on one bond, what would be the expected loss should certain circumstances occur. So what you would say is, what is the risk-free bond attribute? That's the second box down. That's line 10, B10. So on that second box, that's assuming what would be risk-free. Well, by definition, assuming that you're happy with the U.S. Treasury, that would be considered a risk-free bond. Then the corporate bond on top, you could say it's a corporate bond. You could call it a school district bond. You could call it a municipal bond. Call it anything you want. The numbers would simply be plugged into that formula. Well, then what you're really looking for, and by the way, there's multiple ways of looking at this. You can get online and say, give me a bond formula, et cetera, et cetera. This is a simplistic approach. There's one that I prefer, which is a Black-Scholes-Merton formula approach. Doesn't matter. It's going to get you fairly close to the same area. So then you would try to determine what is the probability of default. And the way you do that is simply taking a formula against the risk-free bond as compared to the corporate bond. And then based on these numbers that are in yellow, then you would end up with a probability of default at about 15.3%. The loss, given that probability of default, would be about 40%. So if you think you're going to get back $1,000 on a corporate bond, the reality is you're going to get 1,000 minus 339. That's risk. So you may be saying, well, I'm going to get a 12% rate of return on my money. because you didn't understand what's going on under the hood. Well, let's take this down to the school district for a second. School district level. A corporate bond has a company that's backing it. A company usually has assets. If you're Walgreens, you've got stores, you've got real estate, et cetera, et cetera. Well, school districts don't. What the school districts do is they have an implied guarantee, right? Without the real estate taxpayer, they have no tax revenue. End of story. They're broke. Here's the problem. If you simply look at it and say 37% of the population, based on the median household income, cannot afford the roof over their head and therefore cannot afford any increase in taxes, well, by definition, 37% of the real estate tax revenue just vacated. Now,
Mitch, real quick. I want to make sure I understand this. I apologize to interrupt you, man. You sounded really good. But I just to put this in perspective, basically, here's the potential loss right here. Here's the risk of loss. Here's the profit I would make over 5 years. So I'd make about 200, potentially 290 in profit. And what I'm trying to say is, go ahead.
Yeah, that's on, this is the older spreadsheet, but yes. So that yield curve goes to the risk-free bond, which is government treasury.
And what I'm trying to explain is essentially, in order for me to make $58 roughly per year for 5 years, I am putting at risk $339. So to make 290, I'm risking 339 of my own money. If this defaults, my value of my $1,000 would roughly go to $790. So instead of 1,000, it's 790. And you're saying that how could people continue to pay for bonds when everyone is maxed out? Is that correct so far?
Yes. So your statement is true by comparing the corporate bond to the risk-free treasury. In other words, yes, you're risking X dollars. Doesn't matter what the dollars are. The point is you're risking more and you're making less. Now, when you add on top of that, the fact that 37% of the households, based on the median household income in Denton County, cannot afford the roof over their head. And that's very, very similar straight across the United States. It may be 35%, it may be 41%, but it's pretty close. Given the fact that that amount of population cannot afford the roof over their head and or they are going to go bankrupt, means that that revenue stream has vacated. Now, plug that into the formula. And that's when you start seeing that the probability of risk and the probability of loss goes up exponentially to the point where you may end up in reality with bond levels where somebody's willing to take the chance at 30 cents on the dollar. And that is why I'm trying to explain to everybody, these things are hooked at the hip, right? If your revenue stream goes down because the implicit guarantee is not there, and anybody that says that it is, that's fine, show me. Because the math in your own district says that 37%, give or take, of the population, household population, can't afford the roof over their head. That includes multifamily and single family. Well, that's a fact. How are these bonds worth what everybody thinks they're worth?
This is a huge wake-up call. You know, a lot of people rightfully, and I understand why, saying Blackstone controlling the world, when the reality is Blackstone is probably in the biggest debt in the world because that's not even their money. Blackstone's money is pensions. So my question is, when home values go down, say they go down 40%, what does that do to the ability of companies like that, like Blackstone's ability to even pay bonds back? Can they pay bonds back if home values go down 40%?
No, it's BlackRock, but BlackRock is in the exact same boat because they're highly levered on values that are purchased in today's world on what in reality is probably a 6 cap or less, which is a 6% yield, all cash. So to your point, Travis, what is BlackRock really doing? Well, BlackRock is in the management business. They get 2% per annum of revenue based on assets under management, AUM, plus they get 20% of the profits when profits are to be had. Here's the problem. They don't give it about the profits, nor do they give it about the pension holders, the 401ks, or anything else. They're in this business for that 2% asset under management fee. That's it. So when things go bad, BlackRock doesn't care. It's not their money on the table. And even if they had money invested, when you have trillions that you're managing, that 2% covers off an awful lot of money that you allegedly have invested. So if they say, yeah, well, we own 1% of the shares, big frickin' deal, doesn't mean anything, right? It's the assets under management. It's the 2% of the assets under management. And in the meantime, mom and pop, the pension holders, the 401ks, they're all going to get hit, and they're going to get hit hard, because not only do they devalue on the mortgages of their houses, that puts them upside down. So are the 401ks, and so are the pensions. And that comes to the next point. Why did I raise this spreadsheet in the first place? Well, because that spreadsheet, as simple as it is a stress test. Mom and pop, if you've invested in these 401ks, you are exposed to this. And who's doing that stress test for you? Do you think the fund that's handling your 401k did this stress test? Did that fund tie what we all now know through this series of videos to the real estate taxes? Did that stress test occur at any fund that realized that the median household income is such that 37% of a given population anywhere in the United States can't afford the roof over their head? If the answer is no, 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 then everything you're seeing in that spreadsheet is accurate.
The answer is no, 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 Mitch. And I got one more question before we do our closing here. I don't know which is worse here. This may be an impossible question to answer, to really even quantify, but what do you think is impacting employees the most as far as layoffs? So what is creating layoffs? What is the strongest factor in creating layoffs of these three things? Number one, the CEO bonuses. Look at the port strikes. Look at the bonuses. They're taking billions of dollars in bonuses to CEOs for what? For laying off people? They get a bonus for laying off people? The CEO bonuses. Number two, the Federal Reserve and the quantitative easing, not the quantitative tightening. No, the quantitative easing. Or number three, the commitment that these companies have to their shareholders, the stock market. What's contributing more to layoffs here?
1 and 3 are the same thing. So because the way that the CEO pay works, it's tied to the share price. So if the share price goes up because they laid off employees, the CEO wins. With regard to the Federal Reserve, it's both quantitative easing and quantitative tightening. And that comes back to that memo that I wrote called Socialism versus the Collective Society, because I laid out the case that they don't want lower prices. They'll tell you to their face, well, we're going to do what we can to lower these prices. It is a lie. So the Federal Reserve, by doing both quantitative easing and then quantitative tightening, has ping-ponged the entire population to the point where their equity has been stripped. The definition of the ping-ponging is interest up, interest down, interest up, interest down. It creates lack of stability. And that is what has created the equity stripping. And it's being compounded because these debts cannot be paid back. Not at the school level. That's now becoming even apparent at the Frisco ISD. And Frisco was fairly immune to this for many years because their population growth was off the charts. But they've now maxed out their land capacity, which means that the school growth in and of itself will stop. Yet, in November 5th, I believe, they've got a new bond being issued just short of $1 billion. Why? What are you going to do with the money? So you see, that's equity stripping, and now it's affecting even a very well-to-do community. Well, if it's affecting a well-to-do community, what is it doing now to all the current communities that have got older schools that need to be replaced, and there's no bond money to do it because the income isn't there? They can't raise the new bonds, even though they're going to say, we're going to do it. Well, except that the school district is bankrupt.
Well, I know what they're going to do, Mitch. They're going to bankrupt those communities because they're going to take them down with them. Once someone's already bankrupt, you got to let go, man. You can't touch it. If you're bankrupt and you're still asking for money and you're not going to change any of the things you need to change to become solvent, then anyone that does business with you goes down. Anyone that owns your bonds goes down. The implicit guarantee that you give people that I'm going to pay your bills, I can't pay it. I'm maxed out. I'm on the verge of bankruptcy. I mean, I'm not, I'm just saying a lot of people are. I've done so much in my life, Mitch, to try to hedge myself against what's coming, and I'm struggling myself. And I feel like I've been waiting for this to happen for 10 years, and I'm still taking hits. So it's not easy. So I know that if I'm doing all of these things and I'm still suffering, I know a lot of other people are suffering. Let's go to our conclusion, Mitch. Go ahead and start with yours, sir.
Okay, so I just want to come back on something you said. The implicit guarantee, which is what I wrote in that document, is in fact an implicit bankruptcy. If A equals B and B equals C, then A equals C. They're hooked at the hip. First thing. Second thing is there's such a thing called risk mitigation. And part of the risk mitigation is understanding what it is that we're laying out in all these videos. And you can get any bond spreadsheet you want, do whatever you wish. The point of the matter is part of that mitigation is understanding where the hell is your money. And if your money is in one of these 401ks and it's invested in corporate bonds or it's in school bonds, you've got a problem.
If you think that the company that you work for is your family or is your friend, remember this, they are not. Always look after yourself when it comes to career advancement. If you're worried about losing your job, I'm going to tell you what I should have done before I lost everything. The key word there was before, because I did not change before. I lost everything and it took me 9 years to learn my lessons. If I would have rebudgeted, all right? So rebudget, change how you're spending, and in fact, live like you're broke. I'm living, Mitch, and I'm working like I broke. I haven't bought new clothes in how long? This suit right here, you see this suit? I'm wearing the same suit for 2,000 videos. I got the same jacket on half the time. My point is I'm trying to live like I'm broke so that I could win in the future. I believe that there is going to be great deals to be had through the depression that we're about to go through. Now, I could be wrong, but if I'm wrong, guess what? I still have money saved. I still have great credit. I have more comprehension on the economy, and I win. I'm not trapped. I'm renting. I'm not trapped.
The reality, which is what we've been hammering on, is that the balance sheet to mom and pop must be restored, and that is through the elimination of the property taxes in favor of a uniform state's sales tax. And yes, I have been in contact with multiple people on the uniform state sales tax. And when I explain it, they start to back down and say, yeah, okay, this is beginning to make some sense. It's not a perfect system today, but given the right people in the right place, the infrastructure is there. You give it 60 days, that infrastructure can be made as close to perfect across the US as possible. And we've got something that will return the balance sheet to mom and pop, and they can own the land beneath their feet. And then in 30 years, when they go to retire, they've got an asset that's bought and paid for.
There's no more happily ever after. If the banks and the governments can take your property, then we never own. Then you're never an owner of a home. You're literally a glorified renter. Yes. You have to eliminate property tax. And just for the people that are wondering why you guys always talk about property tax, well, listen to this, guys. Property taxes are in the milk that you drink. If you don't drink milk, then it's in the water that you drink. Now, you guys, we're going to let you go. Happy Wednesday. Have a great rest of the week. Your housing market report will be Thursday, tomorrow at 6 p.m. Hopefully, you guys will like that. And other than that, if you guys are out there living your life, you guys know we wish you luck and we hope you win.